Welcome back to the deep dive. Today, we are taking on one of the most complex, really headache-inducing areas in digital finance.
Oh, absolutely. Crypto tax compliance.
Exactly. For anyone who's even touched digital assets, the whole regulatory landscape can feel like it's constantly shifting, and, that fear of penalties is a very real thing.
It's the single largest administrative challenge for the crypto community right now. And you, our listener, have given us a great stack of sources to work with, from deep dives on tax essentials, the pain points of crypto accounting, all the way to a specific solution called PintoPay.
Right. And our mission here isn't just to review one piece of software, it's to synthesize the entire compliance landscape.
We're trying to build a decision-making framework.
Yeah, setting realistic expectations and, most importantly, giving you the knowledge to master your obligations and avoid those potentially massive penalties that are coming, especially with the 2026 reporting cycle getting closer.
So we're moving from regulatory confusion to functional clarity. Let's unpack this and start with the basics.
Okay, so when you look at the source material, the language is pretty consistent. Crypto taxes are always described as daunting, and the consequences of getting it wrong, those hefty penalties, are significant. So before we even talk about tools, we need to clarify the fundamental issue.
What's actually a taxable event?
Exactly. What actions that people often do casually actually trigger a tax event?
That is the cornerstone of any compliance strategy. If you don't know the triggers, you can't possibly track them. And the sources point to three main categories.
Let's hear them.
Okay, first up, trading. This is the one everyone knows.
Right.
Anytime you swap one virtual currency for another, say you sell Bitcoin to purchase Ethereum, that is legally a disposition of property
So you have to calculate the capital gain or loss on the Bitcoin right at that moment.
instantly. Second is staking and, similar yield activities. The rewards you earn from that are generally classified as ordinary income.
The moment you receive them, right? Not when you sell.
The very moment. It doesn't matter if you sell them or just hold them.
And the third one. This one's the real killer for everyday usability.
Spending crypto.
Buying a coffee.
Exactly.
Yeah.
When you use crypto to buy goods or services, that coffee, a flight, you are disposing of an asset. You have to calculate the difference between its value when you got it versus when you spent it.
Imagine doing that for every single purchase all year.
If you have 100 transactions, that's 100 separate cost basis calculations you need for your tax filing. That right there is the headache that's driving this entire industry of automated solutions.
Okay, so that means we have two totally distinct types of tax liability at play. This is critical for you, the listener, to grasp. Can you clarify the difference between capital gains and income tax here?
It matters a great deal because they're taxed at different rates. Capital gains apply when you sell or exchange an asset.
So, trading and spending.
Right. And if you held that asset for over a year, you get the more favorable long-term capital gains rate. Income tax applies to rewards you earn like staking, airdrops, mining.
And that's often taxed at your higher ordinary income rate.
Usually, yes. And that liability starts the second you receive the crypto, even if you never sell it. Understanding that distinction is how you properly anticipate your tax bill and, frankly, keep more of your gains.
That clarity is a fantastic start. But now let's shift from just defining the problem to identifying the tools and strategies for what we're calling our 2026 Crypto Tax Survival Guide.
Okay.
Beyond just knowing what's taxable, what essential steps does someone need to take right now to avoid a complete disaster?
Well, the first thing is we have to get serious about data management. The sources all emphasize that crypto tax software isn't just optional anymore.
It's basically required.
It is, because trying to manually track everything across different wallets, exchanges, and protocols is, well, it's nearly impossible. These tools automate the most crucial part, tracking your cost basis.
I can't stress cost basis enough. That's the number you need to prove how much profit you actually made.
Precisely. Now, moving into a proactive strategy, the main mitigation tool mentioned is tax loss harvesting.
Which is basically selling at a loss to offset gains.
Right. Intentionally realizing losses by selling an asset that's currently valued below what you paid for it to offset your realized capital gains.
But how is this strategy any different in crypto than it is in, say, traditional stocks?
That's where the real insight is? In the U.S., the critical difference is the lack of the wash sale rule.
Okay, explain that.
In traditional finance, if you sell a stock for a loss and then immediately buy it back within 30 days, that loss is disallowed for tax purposes. In crypto, As it stands today, that rule generally does not apply.
So that's a huge advantage.
It's a massive, though maybe temporary advantage. It lets you realize losses to lower your taxes without actually being forced out of your position for a month.
That is a key piece of high-value knowledge.
Yeah.
What about the really complex stuff? Like, what if I got an airdrop or held a token through a hard fork?
Yeah, those are the common ones that trip people up. For events like airdrops or soft forks, the guidance is generally that the crypto you get is taxed as ordinary income, valued at the moment you receive it.
And a hard fork.
That's where the complexity just explodes. If you get a new token on both chains, you might need to split the cost basis of the original asset between the two.
Which just highlights why you need specialized software, right? It's not just for trades.
Not at all. It has to handle these strange, high-stakes events.
So with all this complexity, what criteria should you use when you're looking at all the different tax software options out there?
The sources suggest focusing on two things: connectivity and support. You need software that can connect to all your data sources, your exchanges, your wallets, DeFi protocols, everything.
Because if it can't import the history, you're back to square one.
Right.
Manual entry.
You're defeating the whole purpose.
Yeah.
And secondly, look for clear documentation on how they handle those complex events we just talked about: forks, liquidity provision, borrowing. The best software will have strong accounting methods built in, like FIFO, LIFO, and HIFO.
Okay, we've talked about what to do, but what about when mistakes inevitably happen? Because they will.
The advice from the sources is simple, really. Don't panic. Common mistakes are usually data errors or a miscalculated cost basis. If you find one, the solution is almost always to file an amended return.
Be proactive about fixing it.
Exactly. The tax authorities really do prioritize compliance and transparency over immediate punishment as long as you're trying to fix a genuine mistake. The key is just consistent record keeping from that point forward.
This background on general compliance strategies is absolutely essential. But now, let's pivot and look at how a specific piece of financial infrastructure tries to solve one of those major pain points we identified.
The taxable event created by spending crypto.
Right. Let's talk about PintoPay.
The service is really designed to address that exact headache. PintoPay is defined as a next-gen service that, acts as a secure bridge between crypto and traditional finance.
Its core promise is simple then.
Very simple. Let users spend crypto like it's everyday cash.
Okay, but we've seen crypto cards before. How does this one specifically simplify the tax nightmare compared to, say, me just selling crypto on an exchange and moving the cash to my bank?
The key is centralization and automated record keeping at the point of sale.
Okay.
When you spend from your own decentralized wallet, you have to track that disposition yourself. With a card-based solution like this, the spending transaction is centralized. The infrastructure automatically processes the crypto sale needed to cover the payment.
And the resulting data stream, the record of the cost basis, sale value, gain or loss, is all tracked for you.
It all tracked and aggregated by the card issuer. And that dramatically simplifies the documentation you need for tax season.
That shift from manual to automated tracking is a huge compliance win, even if it does introduce some centralization. Tell us about the payment tech behind it.
It operates on a pretty robust, secure neobank infrastructure. They support fast, legal, worldwide purchases.
And they're branded as standard cards.
Yep, Visa and MasterCard. They support Apple Pay, Google Pay, and you can get physical cards too. Functionally, they're very flexible. Users can top them up instantly with either crypto or traditional fiat.
Flexibility usually comes with a cost, though. We have to look at the economics. What specific fees do the sources mention?
They give us some specific numbers. For an individual user, there's a virtual card fee of 25 USDT, but it's often reduced to 12 USDT.
Okay.
More importantly, for everyday spending, you have the top-up fee. The base deposit fee is 2%, but it's reduced to 1.5% for their main Visa MasterCard virtual card.
That 0.5% might not sound like much, but for high-frequency users, that really adds up and affects the real cost of spending your assets.
It absolutely does.
We've nailed the consumer benefit. Now let's go behind the curtain a bit and fulfill our mission of explaining how this technology actually works from a business perspective. What is PintoPay actually selling to other businesses?
Right, so PintoPay functions as a pure B2B financial logistics infrastructure. They don't just offer one consumer card. They provide other crypto projects, exchanges, fintech companies with the entire toolkit to issue their own branded cards.
So they're selling the payment backbone.
It's a ready-to-use backbone.
I have to push back a little here. Why would a crypto project pay for this when there are arguably cheaper card integrations out there? How do these partners justify what could be a high setup cost?
The justification really lies in two key areas: revenue and retention.
Okay.
First, partners create a whole new revenue stream. They earn commissions every time a card is issued and every time a card is topped up. And second, it strengthens customer loyalty.
How so?
It gives their users an immediate, compliant way to use their tokens, which makes that partner's whole ecosystem stickier.
Do the sources give a concrete example of that revenue projection?
They do. It's all based on volume. The example assumes a partner gets 1,000 active users, and each one spends about $1,000 a month.
So that's $1 million in monthly transaction volume.
Right. And based on a typical revenue split of 1 to 2% of that volume, it translates to a forecast of, say, $10,000 to $20,000 in monthly income for the partner.
Suddenly, that infrastructure cost starts to look like a serious investment in future revenue. A powerful model. Now let's look at the trade-offs a partner has to make. There are two main integration formats with very different price tags.
Correct. And the choice really depends on their existing technical team. The leaner option is the API solution. It costs $9,500.
And who's that for?
It's designed for sophisticated projects that already have their own crypto wallets and are comfortable building their own fintech products. The trade-off is minimal support, only L2 technical support, and no custom branding.
Wait, L2 support. For our audience who isn't deep in B2B tech jargon, can you define L1 versus L2 support in this context?
Sure. L1 or Level 1 support is your frontline customer service. They answer user questions about transactions, lost cards, basic functions.
The direct-to-consumer stuff.
Right. L2, Level 2 is the higher tier back-end technical help. They assist partners with integrating the system, troubleshooting server issues, or fixing major bugs.
So by only offering L2 with the API solution, the partners are taking on all the direct customer service themselves.
Which explains the lower price.
So what's the alternative? The full package for a partner who just wants it to work out of the box.
That would be the white label solution, and it's priced at $30,500. This is the ready-made system. You could deploy it quickly, maybe as a Telegram mini app or something similar.
And it includes everything.
Everything. Custom branding, a pre-built user interface, a full admin panel, and crucially full L1 and L2 support. The partner gets a complete managed service to run their card program.
Okay, before we wrap the infrastructure side, we have to know, is this just theoretical or is it actually processing real-world volume? What did the scale indicators say?
The usage metrics suggest it's pretty robust. The system reports 117,250 total users.
And what about active users?
They service 38,000 monthly active users, or MAU.
That's the number of unique users in a 30-day period.
Right. And even more indicative of daily use, they have 12,500 daily active users, or DAU. These figures show it's a production environment handling a pretty significant real-time transaction load.
Okay, let's bring this all back together for you. We've established the core challenge of crypto is compliance, and it's driven by these frequent taxable events, especially trading and spending.
And the solution landscape requires specialized tools. Financial infrastructure like PintoPay simplifies the tracking of those spending events by centralizing the data around a card.
Exactly. The benefit is undeniable ease of use and automated record keeping for at least one key taxable activity.
For spending, yes. But to maintain our critical perspective, we have to remember that while these tools solve one problem, they do introduce trade-offs.
Like centralizing your data.
Right, within a neobank infrastructure, which for some users might run counter to the whole decentralized ethos.
That's a crucial point. You have to weigh the simplicity of compliance against those foundational choices. And that leads us perfectly into our final provocative thought for you to consider.
We saw two competing factors today. For you, the end user, solutions like PintoPay can offer cost-saving benefits, like reducing deposit fees from 2% down to 1.5%.
But for the B2B partner, the entry costs are substantial. We're talking anywhere from $9,500 to over $30,000 just for setup.
Right.
So here is the question for you to mull over. Beyond simply making spending records easier, how do these cost structures ultimately shape the market?
Do those high B2B setup costs act as a barrier, ensuring that only the large, well-funded projects can offer the most compliant and flexible spending solutions?
And if that's the case, how does that affect which segment of the market, the high net worth individual or the casual retail user, is truly getting the most cost-effective solution for staying compliant?
In short, who benefits most from the very infrastructure that's required to make compliance easy? It's something worth thinking about as you finalize your 2026 survival guide.
That's all the time we have for this deep dive. We hope this has given you a massive head start on mastering crypto tax complexity. We'll see you next time.